Welcome back to Dreamlit Equity Research. Today we're mapping the entire U.S. ETF landscape, structure, examples, and comparative data. Scale first. As of year-end 2025, U.S.-listed ETFs hold $13.4 trillion in net assets across 4,495 registered funds, now 30% of all U.S. fund industry assets. This is educational research, not personalized financial advice. Verify every figure against a primary source before acting. Let's begin. Quick disclaimer, because it matters. This is educational content, not financial, legal, or tax advice. I'm not a licensed advisor, and I'm not registered with the SEC or SEBI. Everything here reflects my own opinions, which can and do change as new data comes in. Investing carries real risk, including loss of principal. Do your own research and consult a professional before acting on anything. All data comes from public filings, earnings releases, and publicly available research used under fair use for commentary and analysis. With that said, let's get into it. 8 sections ahead. What an ETF is and how it compares to a mutual fund and a stock. How the creation and redemption mechanism keeps price honest. What fees cost compounded over decades. The overlap trap hiding inside common portfolios. The full menu of ETF categories. Specialized ETFs, thematic, leverage crypto, where to verify data, and a due diligence checklist before you buy. Watch in order. The fee math changes how you read everything after it. An ETF is a basket of securities, stocks, bonds, commodities, trading on exchange all day, just like a single stock, while holding a diversified portfolio inside. SPY, the first U.S. ETF, launched in 1993. Bond ETFs followed in 2002, commodities in 2004. Most ETFs are passive, tracking an index rather than picking stocks, which keeps fees low. Price floats close to net asset value through an arbitrage mechanism we'll cover next. Common tickers: VOO, SPY, QQQ, VTI, ADG, each mapped to a different index and strategy. ETFs are regulated under the Investment Company Act of 1940. Side by side with the products people confuse ETFs with. Trading: ETFs and stocks trade all day at live prices. Mutual funds trade once daily at end of day NAV. Minimum investment: 1 share or a fraction for ETFs, often $500 to $3,000 for mutual funds. Expense ratio: ETFs run 0.02% to 0.75%. Mutual funds run 0.5% to 1.5%, plus stocks carry none. Tax efficiency: ETFs benefit from in-kind redemptions, generally more efficient than mutual funds, which often force capital gains distributions on every holder. Diversification: high for both ETFs and mutual funds, none for a single stock. The mechanism that keeps ETF prices honest. An authorized participant, a large institutional trading firm, is the only entity that can create or redeem ETF shares directly with the fund. It delivers a creation unit, a basket of the underlying securities, and receives new ETF shares in exchange. Those shares then trade freely on the exchange all day. Because large players can create or redeem directly, arbitrage keeps market price tightly anchored to NAV. The same in-kind mechanism behind ETF's tax efficiency, since those transfers generally don't trigger a taxable event inside the fund. $100,000 invested at 8% annual return over 30 years. Fee as the only variable. At 0.03%, VOO's level. The fee cost is roughly $8,000. At 0.2%, near QQQ, about $54,000. At 0.75%, typical of an active ETF like ARKK, about $177,000. At 1%, common for active mutual funds, about $230,000. Same starting capital, same market return. The entire gap comes from what the fund charges to hold it. 8 risk types matched to real funds. Market risk hits any equity ETF when the whole market drops. Concentration risk shows up in QQQ and XLK's mega cap weighting. Sector risk hits XLE or XLF when one industry underperforms. Interest rate risk is sharpest in TLT's long-duration treasuries. Liquidity risk concentrates in niche thematic ETFs. Leverage decay erodes TQQQ and SOXL through daily reset compounding. Currency risk applies to unhedged funds like VXUS or EWJ. Enclosure risk mostly threatens small, unpopular thematic funds. Ask which of these actually applies before buying. A common portfolio mistake dressed up as diversification. VOO is weighted toward Apple, Microsoft, and NVIDIA. VTI holds those same megacaps plus smaller companies layered around them. About 85% overlap with VOO. QQQ holds the same top names through a tech lens. Roughly 90% overlap in the top 10 holdings. You think you own 3 different funds. You basically own one fund 3 times. Check actual top 10 holdings before assuming more tickers means more diversification. 6 major categories. Equity ETFs track broad indexes like the S&P 500 or NASDAQ 100, or narrower styles like growth and value. Bond ETFs hold treasuries, corporates, or munis. $2.2 trillion in assets, 17% of the market. Sector ETFs concentrate in tech, healthcare, energy, and more. International ETFs cover developed and emerging markets outside the U.S. Commodity ETFs track gold, oil, and broad baskets. And leveraged or inverse ETFs aim for 2 or 3 times an index's daily return, or its inverse, short-term tools only. 5 cost concepts before the category tour. Expense ratio, the annual fee, roughly 0.1% for index ETFs, 0.45% for active ETFs. Bid-ask spread, wider for thinly traded funds. Tracking error, how closely the ETF follows its index. Trading commission, mostly $0 at U.S. brokerages now. And premium or discount to NAV. Market price can briefly drift from fund value in volatile or illiquid conditions. Check volume and spread, not just the headline fee. One table, every category side by side. Broad market, VOO, VTI, QQQ, 0.02% to 0.20%, the core portfolio foundation. Sector, XLK, XLE, XLF, 0.08% to 0.35%, a tactical tilt, not a core. Dividend, SCHD, VAG, JEPI, 0.05% to 0.60% for income seekers. Bond BND, AGG, TLT, 0.03% to 0.48%, ballast against equities. Commodity and International, GLD, VXUS, VWO, 0.03% to 0.74%. Thematic, ARKK, BOTZ, ICLN, 0.39% to 0.75%, satellite only. Leveraged and inverse, TQQQ, SOXL, SQQQ, 0.75% to 0.95%, short-term trading only. Crypto, IBIT, FBTC, BITO, 0.25% to 0.95%, high volatility satellite. The foundation of most portfolios. VOO tracks the S&P 500 at 0.03%, a 17.8% one-year return. SPY tracks the same index at a higher 0.0945%. IVV matches VOO's 0.03% fee. SBLG runs even cheaper at 0.02%. VTI covers the total U.S. market, nearly 3,700 holdings, still at 0.03%, with a 17% one-year return. QQQ tracks the NASDAQ 100 at 0.2%, the strongest one-year return here at 21.9%. DI tracks the Dow Jones 30 at 0.16%. Broader exposure tends to come with lower fees. Same index, 3 different vehicles. VO comes from Vanguard, SPY from State Street, IVV from BlackRock's iShares. VO and IVEV are open-end funds. SPY is an older unit investment trust. VOO and IVV charge 0.03%. SPY charges 0.0945%, roughly 3 times as much for identical exposure. VOO and IVV reinvest dividends efficiently. SPY's structure leaves cash sitting until the next payout. VOO and IVV suit buy and hold investors. SPY suits active and options traders, with the deepest liquidity of any ETF. That fee gap looks trivial. Compounded over 30 years, it's thousands of avoidable dollars. Concentrated bets on one slice of the economy. The SPDR Select Sector family charges 0.08% across technology, XLK, healthcare, XLV, financials, XLF, energy, XLE, real estate, XLRE, and utilities, XLU. Technology led on returns at 24% 1 year. The standout cost is semiconductors, SMH or SOXX, at 0.35%, more than 4 times the standard sector fee, but also the strongest 1-year return in this group at 32%. Sector ETFs trade broad diversification for a concentrated industry bet. Another way to slice the market, by style. VUG represents growth at 0.04%. VDV represents value at 0.04%. VO represents blend at 0.03%. Growth ETFs concentrate in companies expected to grow earnings fast, historically more volatile. Value ETFs favor cheaply priced, steadier companies. Blend funds like VO hold both together in natural market cap weighting, the default starting point for most investors. Income-oriented, but not built the same way. SCHD targets dividend growth and quality at 0.06%, yielding around 3.5%. VIG targets pure dividend growth at 0.05%, yielding 1.8%. DGRO does similar at 0.08%, yielding 2.2%. JEPI uses covered calls at 0.35%, yielding 7 to 8%. QYLD, also covered call, charges 0.6% and yields 11 to 12%, but its 5-year annualized return trails at just 2.5%. A sign part of that yield comes from principal, not pure income. Always check total return, not yield alone. Fixed income across duration and credit quality. BND and AGG track the total U.S. bond market at 0.03%. TLT holds 20-plus year treasuries at 0.15%. The most rate-sensitive fund here, down 6.5% annualized over 5 years as rates rose. SHI holds 1 to 3 year treasuries, also 0.15%, but far less rate-sensitive, up 2% over 5 years. LQD holds investment-grade corporates at 0.14%. HYG holds high-yield corporates at 0.48%. TIP holds inflation-protected treasuries at 0.19%. Duration and credit quality are the 2 dials that matter most. Real asset exposure. GLD tracks gold at 0.4%, up roughly 42% over 1 year. IU tracks the same gold at a cheaper 0.25%. SLV tracks silver at 0.5%, up 55% over 1 year. USO tracks oil at 0.6% or higher, often via futures, which can create tracking differences versus the spot price, and it's down 5% over the past year while gold and silver rallied. Exposure outside the US VXUS covers developed and emerging markets ex-US at 0.05%. VA isolates developed markets ex-US at 0.03%. VWO targets emerging markets at 0.07%. EM also targets emerging markets but charges 0.68%, nearly 10 times VWO's fee for broadly similar exposure. FXI concentrates on Chinese large caps at 0.74%. INDA concentrates on India at 0.65%, with the strongest 5-year return in this group at 11%. Broader, standardized exposure tends to be cheap, single country exposure tends to cost more. Narrative-driven bets on emerging trends. ARKK targets disruptive innovation at 0.75%, down 8% annualized over 3 years. VOO targets robotics and AI at 0.68%, up 15% annualized over 3 years. ICLN targets clean energy at 0.39%, down 12% annualized over 3 years. HAC targets cybersecurity at 0.6%. URNM targets uranium and nuclear at 0.75%. The strongest 5-year return here at 20%. Results vary wildly by theme. Treat these as a small satellite allocation, not a core holding. One of the most misunderstood categories. TQQQ delivers 3x the NASDAQ 100's daily return at 0.84%. SWXL delivers 3x the semiconductor sector's daily return at 0.75%. UPRO delivers 3x the S&P 500's daily return at 0.91%. SQQQ delivers negative 3x the NASDAQ 100's daily return at 0.95%, down 55% annualized over 3 years. The key concept is daily reset. Leverage recalculates every single day, not over your holding period, so a choppy sideways market can leave these funds worse off than flat. They're short-term tactical tools, not buy-and-hold investments. Digital asset exposure through a normal brokerage account. IBIT tracks spot Bitcoin at 0.25%, down 8% over the past year. FBDC also tracks spot Bitcoin at 0.25%. BITO tracks Bitcoin through futures rather than holding the coin directly, at a much higher 0.95%, down 11% over the past year. Spot funds hold the actual asset. Futures-based funds hold contracts that can drift from spot price due to contango, part of why BITO's fee runs nearly 4 times the spot alternatives. One table, every category, fees against 5-year annualized returns. Large-cap S&P 500 funds like VOO run 0.03% with roughly 13% a year. NASDAQ and growth funds like QQQ run 0.2% with about 15% a year. Total market funds like VTI run 0.03% with about 12% a year. Dividend funds like SCHD run 0.06% with about 9% a year. Technology sector funds like XLK lead at roughly 21% a year on a 0.08% fee. International funds like VXUS run 0.05% with about 8% a year. Bonds like BND run 0.03% near flat. Gold via GLD runs 0.4% with about 17% a year. Thematic and crypto funds remain highly volatile or too new to rate reliably. 4 fast-growing innovations. Spot crypto ETFs. The SEC approved spot Bitcoin ETFs in January 2024 and spot Ether ETFs in May 2024. Combined spot Bitcoin ETF assets have topped $120 billion. ETF share classes. In 2025, the SEC let mutual funds add an ETF as another share class of the same strategy, with over 30 asset managers cleared and launches beginning in 2026. Buffer, or defined outcome ETFs, use options to cap both upside and downside. And derivative income ETFs sell call options for extra income. This category has grown from about $6 billion to over $180 billion in 5 years. Every number here expires eventually. ETF.com is strong for fees, holdings, and side-by-side comparisons. Morningstar offers independent ratings and risk metrics. Fund provider fact sheets, Vanguard, iShares, State Street, Invesco are the primary source. If a number conflicts anywhere else, the issuer wins. Brokerage screeners like Fidelity or Schwab give live, account-linked data. Use this video as a map of the landscape, then verify the specific numbers before you act. 5 steps to your first ETF. Open a brokerage account. Most now charge $0 commission on U.S.-listed ETF trades. Fund the account by linking a bank and transferring cash. Many brokers support fractional shares. Search the ticker and verify it against the issuer's fact sheet. Choose an order type. A market order fills immediately. A limit order only fills at your price or better. A stop order triggers once a threshold is hit, and a fractional order buys a dollar amount instead of whole shares. Then review and submit. Opening the account is usually the slowest part. 6 checks before buying any ETF. Expense ratio. Lower is better against similar funds. Assets under management. Larger funds tend to have tighter spreads and lower closure risk. Average daily volume. Higher means easier entry and exit. Tracking error. How closely returns have matched the benchmark. Underlying holdings. Read the actual portfolio, since similar names can hold very different assets. An issuer and structure. Confirm whether it's a standard 1940 Act fund, an ETN, or a commodity pool. 10 minutes per fund saves most common mistakes. 5 things to remember. Fees compound quietly. A 0.03% fund versus a 1% fund on $100,000 over 30 years is roughly a $220,000 gap on identical market returns. Diversification can be an illusion. VOO, VTI, and QQQ overlap 85 to 90% in top holdings. Broad market is the benchmark to beat. Low-cost S&P 500 NASDAQ. 100 funds have outpaced most sector, thematic, and leveraged alternatives on a risk-adjusted basis over 5 years. Specialized ETFs are satellites, not cores. And always verify before you buy. Expense ratios, assets, and returns shift quarterly. This is educational research, not personalized advice. Thanks for watching Dreamlit Equity Research.